Well, natural gas futures rose on Tuesday, extending gains after hitting an 8-month high in the previous session. Traders are betting on another round of cold weather in December and firmer power demand, keeping sentiment bullish despite the expected warm-up ahead, a clear warning sign that the ongoing rally is driven by speculation rather than fundamentals. The recent rally has kept the front-month contract in technically overbought territory for a ninth straight session. The latest forecast points to cold conditions gripping much of the eastern U.S. through midweek before a warmer trend takes over. This expected dip in national demand could put short-term pressure on prices, unless, of course, the next set of models magically turn colder again for early December. Traders, as usual, are fixated on forecasts beyond 15 days, even though they're far from reliable, treating every hint of cold like gospel. Any further upside at this point will likely depend on whether late November forecasts can actually deliver the chill they've been promising. Besides the cold weather, a recent record pace of export activity has added to recent bullish sentiment. But we can also indicate a strong pace of production that has provided significant mitigation against the rising exports. Meanwhile, in the cash market, average prices at the Waha hub in the Permian Shale Basin in West Texas remained in negative territory for a sixth session in a row as pipeline constraints trapped gas in the nation's biggest oil-producing basin, and this is another bearish warning that the local U.S. market is oversupplied. Moreover, European nat gas prices traded in a narrow range on Tuesday as mild weather keeps heating demand subdued and amid strong supply from Norway in liquefied natural gas, telling us that U.S. prices are far from reality currently. Okay, let's get back to reality for a moment. Average gas output in the lower 48 has climbed to a whopping 109 billion cubic feet per day so far in November, up from 107 in October and even topping the record 108 in August. In other words, production just keeps hitting new highs while everyone's busy pretending supply is somehow tight. This high output has allowed companies to stuff more gas into storage than usual, about 4% above normal for this time of year. But sure, let's keep calling it a shortage-driven rally. Meanwhile, LNG exports are cruising along nicely too, averaging 17.8 billion cubic feet per day in November compared with last month's record 16.7 billion. That's impressive, but not nearly enough to erase the hefty storage surplus, still sitting comfortably above 162 billion cubic feet versus the 5-year average. Naturally, that hasn't stopped the fair price models from flashing overvaluation warnings like Christmas lights. Analysts expect total U.S. gas demand, including exports, to jump to 118.6 billion cubic feet per day this week from 108.6 last week thanks to colder weather, likely bringing the season's first storage withdrawal in next week's report. But after that, demand should ease back to around 114.7 billion cubic feet per day as temperatures moderate. This is expected to be followed by yet another bearish storage report, which could add further pressure on prices and reinforce the sense that the market is oversupplied despite ongoing speculative optimism. Even more telling, today's forecast cut HDDs down to 228 for the next 2 weeks, compared with 246 just a day ago. The market's pretending not to notice, for now. Once reality sets in, though, that adjustment could spark quite a correction. Especially since storage surplus is projected to increase to around 174 billion cubic feet by the end of November, despite all the ongoing fantasies about surging demand. Natural gas futures continue to hold above the $4.30 support zone, maintaining a bullish short-term structure after last week's breakout to an 8-month high of $4.50. However, momentum indicators show signs of exhaustion. The RSI remains elevated above 70, keeping the market in overbought territory for over a week, a clear sign that buyers are running hot. The 50-day moving average has now risen toward $3.97, while the 200-day sits near $4.45, effectively forming a technical pivot cluster that will decide whether this rally can sustain or fade. A daily close above $4.50 would likely trigger stop-driven buying, targeting the next resistance near $4.60 zone. Failure to hold above $4.30 could invite a correction toward the $4.10 range. Volume data show diminishing participation on each new push higher, suggesting bullish fatigue. In contrast, open interest continues to climb, indicating new speculative longs entering late, a typical setup before a short-term pullback. Don't forget to leave a comment and check out the ads to support the channel. See you in the next one.